The Federal Reserve has decided to start tapering. Let's talk about what that means for you, the stock market, educational at best, maybe just only entertainment, but certainly not financial advice, because the Federal Reserve, that's a tricky one, hard to understand. But let's go into the three traditional tools they have. One is open market operations. That's really what we're going to talk about. That includes mostly just buying, selling bonds, which we'll get to in a second. The other is changing reserve requirements. So for example, a bank has to have a certain amount of money in the bank, meaning people deposited money in the bank, and then they're able to loan out a certain percentage or multiplier of that money. So if they have $100 in the bank, they might be able to lend out $1,000. And the Federal Reserve has control over that, and so that will affect how much money is in the system, in the economy. And they can change the discount rate, so how much they're going to pay interest rates or demand interest rates, whatever that might be. Now, when we talk about the government, they are, for example, going to need money, and so they'll create a bond. And pretty much that is just a general loan, meaning you give us money, and we'll pay you back a higher amount. So you give us $1 million today, we'll give you $1,100,000, next year, for example. And so a bank will come along and they'll say, yeah, we'll take that, and yes, we'll give you the cash. And of course, it's the same thing besides the government. You could have a business, industry, whatever that might be. And if we look at the Fed's balance sheet after the Great Recession, the recession in 2007, you can see it has steadily been going up since then. And there was a slight time where that kind of stopped, where that was a previous tapering, okay? Now, tapering, this is very important, does not mean that they're going to unwind, does not mean that they're going to sell. You can see in the middle of this chart, when it starts to just level off, that's when they successfully, quote-unquote, taper. That means they're not buying any more bonds. The unwinding happens slightly after that, right before the crisis we're in right now. And then it shoots dramatically up, pretty much doubles. I know here it's a 7 trillion, but I'm pretty sure we're up to 8 trillion. We'll talk about that in a second. And so they're going to taper. They're going to start trying to buy less and eventually plateau, no longer buy any more. Now, this is going to be very tricky. And of course, they're going to have to start to unwind, presumably. Now, the Federal Reserve, according to CNBC, they're going to dial back its bond buying, and they see 3 rate hikes next year. Is that really true? Are they going to raise interest rates, in 2022? I'm not buying it exactly, but that's what CNBC certainly believes. Now, they were buying, the Fed will be buying, $60 billion of bonds each month starting in January in the new year, and that's half of what was happening, let's say, in November. And that's $30 billion less than was happening in December. So already they've started to taper. And, they went from 120 billion, let's say, a month to 90 billion in December, and we haven't seen the market crash. And they are going to go to 2/3 of that. So they're going to go down to 60 billion, right? And so whatever the exact numbers are, the point is that they were tapering before, and they will be tapering, continue to taper. And the question is this going to cause some massive, massive issue in the stock market? Now, the Fed will no longer be adding to their portfolio. And according to this article, that means that by the end of, QE will end by spring. And then the central bank will be able to raise rates. And they could then, after that, anytime start reducing its balance sheet. Okay, now let's talk about what is the big issue. Because once upon a time, the Federal Reserve, as you saw in that graph before, in 2013, started to do this, and it was called the Taper Tantrum. Okay, that does not sound good. Now, Ben Bernanke said at the first time in a congressional testimony publicly, he mentioned it, if we see continued improvement and we have confidence that it's going to be sustained, then we could, in the next few meetings, meaning not right away, take a step down in our pace of purchases. Okay, so exactly what we're talking about now. He's just talking about not even tapering, right? So right now we're already doing better. Right now we're already tapering. We're not seeing some crazy reaction from the stock market. That is good. Here in the taper tantrum, he was just mentioning the idea of tapering, and there was a problem. So already we're a little bit ahead, which I think is a good sign, as far as I understand. And so pretty much from that public disclosure, it went from 1.94%, the 10-year treasury yield, to 2.03. Now, we're not that high, and whatever interest rates are being pushed down substantially. So we'll see what exactly happens. Now, that sounds like not a big deal, not 10%, but it's 0.10%. And however, it went up 50%. So a lot of percentages here. So it went from 1.94 to 2.96% from the end of May to September 10th. That's pretty fast. And so that's what people refer to as the taper tantrum. And he nevertheless tried to, assure people the reduction in asset purchases would be gradual. It obviously did not help. People just, saw, okay, you're going to stop tapering, then you're going to unwind. Now, on that chart, you saw that the unwinding didn't happen for a long time. And that might signal to markets this time that the same thing is going to happen. And that might help confidence and trust. Now, what is interesting about what happened last time is it drove capital outflows and currency depreciations in emerging markets like Brazil, India, Indonesia, South Africa, and Turkey. Now, why might that be? Just in my simple brain, well, if I can get 3% from the US government, which I know is not going to default, that's better than getting 4, 5, 6, 7% from a country that I have no idea if I'm going to get my money back. Maybe that was better than the 2% that I was previously going to be getting, but 3%, maybe that's a better deal. So I'm assuming that's what happens in these situations. So really interesting. And so if someone's invested in some of these other markets, you have to really consider that fact that as the bond market goes up in the US, that might have a really negative impact in emerging markets. Okay, now the Federal Reserve wants to distinguish its short-term interest rate policy from tapering, right? And so they're trying to really push this point that tapering will precede any consideration of rate hikes, meaning they're going to be done tapering. They're not going to raise rates even if inflation's happening. They're really going to do the tapering first. Don't worry about the interest rates being increased. And pretty much Jerome Powell's, the Federal Reserve chair, is pretty much saying our decision today to begin tapering, it's not a signal about interest rates pretty much at all. And they're going to have a totally different test for that. And, like you saw with Ben Bernanke, don't start extrapolating the market. Don't start getting nervous about everything that's going to happen. This is, they pretty much want to say this is meaningless. This is not a big deal. I know you're worried about interest rates. I am too. And so that's really what they're trying to convey. Now, maybe you're going to say, well, doth do protest too much, right? Perhaps that's an issue. And so we'll see what happens. And the big issue here is that there's a lot of consumer confidence. Well, not consumer confidence, but investor confidence, I should say. And that's really going to be the biggest issue, in my opinion. Do people trust the Federal Reserve? And of course, trust in institutions all-time low does not bode well for the Federal Reserve. On the other hand, so far they've done the tapering quite aggressively without any backlash. That's pretty impressive. Well, as far as I can see it, without any backlash. Now, if we're looking at the balance sheet for the Federal Reserve, and this is why I say I am not an expert, certainly not in bonds, and the Federal Reserve is way more complicated than bonds, simple bond purchases and sales. But they have 8.29 trillion, I was going to say trillion, in securities held outright, and a huge portion of that, about 4.86 trillion, is notes and bonds from the U.S. Treasury securities. And so pretty much the difference between bills, notes, and bonds, it's going to be just when, as far as I understand, it's just when the term when they're due. So bills are very short term, whereas notes and bonds are going to be, maybe 10 years, whatever, 20, 30 years, whatever the terms are going to be. And so those are much longer. That's really the difference. Now, what's interesting also here is you can see the mortgage-backed securities, which I don't think they had in the previous Great Recession or whatever they were calling it, the 2008 collapse. I could be wrong. I think mortgage-backed securities are much bigger in this policy, this turn of quantitative easing, whatever you want to call it. And that's going to give the Federal Reserve, I think, a lot more leeway, a lot more interesting leeway, I think. And I think there's going to be a lot more tricks up the Federal Reserve's sleeve this time. I could be totally wrong. And they are a lot more open and quote-unquote honest, well, quote-unquote open as well, this time around than in previous Federal Reserve chairs. So it could be that, I'm going to be a little conspiratorial now, and I'm going to have my own theories, and I'll tell you them, and you let me know your theories. By the way, please like, comment, subscribe. Helps share the channel. I appreciate that. And I'm trying to put out some more videos just so everyone, especially during this time when a lot of people are not putting out videos because they're at home with family, I just want to make sure that there's some interesting insights still going on while the markets, while everything still, life is still happening around us. So what I think that's very possible that the Federal Reserve could actually do, and like I said, not an expert, is with this $2.6 trillion or this $4.86 trillion, they can really move money around. What do I mean? So they could, for example, taper, meaning their balance sheet is not growing. However, they're still buying more bonds. How is that possible? well, they could sell their mortgage-backed securities to banks at a higher value. So for example, right now, right, they're not saying they're raising interest rates. They might be able to tell banks that they don't foresee the next time that they're going to be able to raise interest rates. And so the banks might see an opportunity here to buy these mortgage-backed securities. Maybe the Federal Reserve even makes some money. Who knows? I doubt it, but who knows? And so they could actually lower their balance sheet, make some profit, and yet, because they're tapering, because people are scared about their bond purchases, well, they could still buy more bonds. And so they're going to float that area of the market. So people will say, oh, wow, they're tapering. They're not growing their balance sheet. And yet the bond market's totally fine. I'm not going to make any money in the bond market. So I'm going to go put more money in the stock market, going to prevent the stock market collapse, going to make sure there's money available. And that might give people a sense of security, right? And so when they really do stop buying bonds entirely, then the market will pretty much say, well, maybe there's not as much money, but, I'm going to put more money, whatever it is. The bond market won't react so violently because they think that the Federal Reserve hasn't been buying bonds for a while. Well, the Federal Reserve can kind of slowly allow the rates to come up slowly because they're still buying bonds. They're just selling their mortgage-backed securities at a greater rate, let's say. And so they're still buying bonds, still keeping their balance sheet at a plateau, not really increasing the balance sheet. They're just transferring assets. And so as they allow the rates to slowly go up in the bond market, then banks will eventually come in and start putting money in there as well because they want to get a piece of that, interest rate action. So that, to me, makes the most sense. It seems so obvious. It seems like that's what the Federal Reserve will do. I have no idea, though. That would be like a tricky, sneaky way of doing it. The open, honest way of doing it would be, no, they really are tapering. They really are trying to slow things down in terms of their purchases. And yeah, the market really is reacting pretty well, which is surprising, but nevertheless, that's what's happening. And so, they don't have to worry. And they don't have to worry because last time they didn't unwind for let's say 5 years, whatever it was. I don't remember exactly. A year, 2, 3 years, whatever it is. And so now the Federal Reserve can kind of use that as an example of saying, yeah, I know you think tapering means that everything's going back. It's not. We're going to be here 2, 3 years, 4, 5, 6, 7 years, whatever it's going to take before we do. Now, the interesting thing there is if they really do send that signal, not like I was saying before about them moving their assets around and trying to play some sort of trick with the market and coax people into a sense of security, right? So if they don't do that and they really are trying to be honest and saying, we're just tapering and the market's fine, don't worry about it, we're not doing anything else. Well, the interesting thing there is that some of these notes and bonds will come due and will naturally come off the Federal Reserve's balance sheet because the government will, in theory, pay off those bonds and notes. That's assuming the government pays off their bonds and notes without needing more bonds and notes being purchased by the Federal Reserve. So that's asking a lot, I suppose. And that means that taxes might have to go up. Now, there is a third option. I'm sure there's 4, 5, 6, 7 other options, but these are the most obvious ones. Now, by the way, that last one, to me, very intriguing. The only risk to, before we get onto the third option, the only risk of them holding on to these assets is what happens if there's another financial issue. Right after 2008, 2009, when they kept quantitative easing going for so long, and then 2013 they wanted to start unwind. Well, by the end, when they were really getting into the, let's say, groove of unwinding, we got this massive, crisis that we're going through right now. Well, luckily they started to unwind. Certainly not enough. But could you imagine if they unwound entirely? Well, this would be a very different picture we're in. And so, on one hand, the Federal Reserve, if they don't unwind, if they just let this thing go on for 10 years, they're taking a risk. What happens if there's another crisis, whether it's war, whether it's biological, whatever it might be, that is a risk. And so they are probably going to want to unwind. Whether they will or won't, that's a different question. Now, the third option is inflation. Now, I've heard a lot of the Federal Reserves, and a chairman, and I said this a long time ago to people I knew that, inflation is not so bad for the Federal Reserve. As long as it doesn't destroy the market and the economy, they don't mind inflation. And why is that? Well, it means all the money that they're owed is much easier to pay back for the government. So, for example, just an extreme case, let's say you're being paid 100 grand. That's a nice salary. And then because of inflation, that's worth 50%, meaning for you to buy the same goods, you'd have to be paid 200 grand. Now, this is once again extreme. I don't think the Federal Reserve wants that much inflation. But if you're now going to have to make 200 grand and the tax system doesn't change, well, you're paying a lot more money into taxes. The government's able to pay off a lot more of their debt without them changing anything. So that's an extreme example to just show you that the inflation is, a hidden tax. That's what they call it, a hidden tax on everyone, and it'll affect everyone badly, whether you're wealthy or whether you're poor. Inflation is going to be very difficult for everyone, and it's going to be a tax equally on everyone. And so that's one way that, in theory, the Federal Reserve could solve this problem for the government, is by being a little bit less aggressive to inflation. Now, one of the problems with that is you can really destroy an economy, a trust in money, trust in all of these different things. However, if they can play this fine line with letting inflation rates go above 2%, which I'm sure they are, well, now they're at 4%, but they're not going to get higher. And then, maybe they come down to 3% and they play with the numbers because they have a lot of control about how they claim what the CPI, what the inflation numbers are. And then maybe, a year later they say, oh yeah, we said it was 3%, but it really turns out it was 4% or 5% or whatever it was. So they have a lot of leeway and they can readjust things. They can, do tons of stuff to really affect inflation. And this could be another way out. And of course, when inflation goes up, the stock market tends to do badly because no one wants to buy, well, I shouldn't say no one wants to buy, but no one wants to buy actually bonds in particular, because their money is just going to be worth less. And so the bond market shoots up quite a bit, and people take their money out of the stock market and they decide to buy bonds at 3%. That's a much better deal than the stock market, because I'm for sure, let's say, going to get my bonds back at 3%. Maybe that's beating, or maybe it's not even beating inflation, but I know I'm not going to lose money. And I know my cash is going to go up in value, not up in value, but up in number, even if it's less than inflation, but it's a hedge, or it's less of a risk. So that's a strong possibility. Now, of course, on the other hand, that also means that, well, maybe how much are people willing to lose to inflation for a returns guarantee from the government? So, for example, let's say you have some sort of fund, some sort of retirement fund, whatever that might be. Someone has 100 grand in it. They might want that stock market return of 10%. But what about the risk? What happens if there's a risk that you lose like 20, 30%? Well, that fund might decide, you know what, we'll go for the 1% return. So we're going to return you 101 grand, not 110 grand. But you're for sure not going to lose any money. Now you will in real terms, because inflation will go up and your 101 grand will be worth less. But the number in your bank account will not get smaller. And so that might be very preferable to some funds that want to keep their investors happy. They're going to say, well, we didn't lose money. And so that might also keep some of these bond prices down. That might be to the Federal Reserve's credit, that the stock market, as it keeps going up and it's inflated, and maybe they should have started tapering sooner, but maybe some of these funds will help buy bonds along with the Federal Reserve. And so the Federal Reserve can kind of taper, lean back, allow other private institutions buy these bonds because they want the for sure return versus the very risky, very inflated stock market. Now, I've been saying for a while, I think that there's going to be a crash, or I shouldn't say crash, but certainly a correction. I just think it's been going so strong, so high for so long, which is a little uncanny for the stock market. And we'll see when that happens. I'm not saying it's going to happen with this tapering. It might happen with the unwinding. It might happen with some random event. Who knows? And that's why I'm very short-term, buying options, things like that. And so you can go back to some of my other videos like Yum, where I said it's going to explode. That's a very useful kind of logistic where you can say, oh, there's a strong likelihood that this stock, it's going to shoot up. And yes, it did. And, in the short term, if you're playing that trade, that's the way you can make money. I'm not saying that's what you should do. I'm just saying that there's a lot of risk in the market right now. And there's a lot of risk with this tapering, and especially what's going to happen with the with the unwinding, I should say. And, let me know your thoughts. Please like, comment, subscribe. I really appreciate it. I also really appreciate your thoughts, because you guys teach me a lot. And you ask good questions, make me research more, make me think about things differently. So those are 3 different options I think the Federal Reserve could go through to do their tapering. I don't know. I find it fascinating. But like I said, it's definitely not an expert. I'm curious to see what will happen. That's for sure.